Welcome to the Deep Dive, the place where we take that fire hose of information you send us, and we try to distill it down to what's essential, maybe surprising, and hopefully truly useful.
Yeah, and today we are definitely undertaking a critical deep dive. We're looking at this really huge shift that's kind of reshaping global finance. It's the democratization of private funds.
Right.
For decades, this whole world, private equity, venture capital, private credit. It was high return, sure, but often pretty opaque. And it was strictly reserved for the big players, the titans.
Yeah, the massive university endowments, sovereign wealth funds, the biggest corporate pensions. Only them.
Exactly.
But that wall, as you've probably noticed if you're paying attention to finance at all, it's collapsing fast.
Mm-hmm.
I mean, you can't scroll through LinkedIn. You can't open a financial news site without seeing ads, right? Platforms like Yield Street, Fundrise, and a whole bunch of others.
Oh, yeah, they're everywhere.
And they're aggressively marketing these private assets to everyday accredited investors, to high net worth folks heading into retirement, sophisticated savers who, frankly, had zero access before.
And the pitch is always about democratization, isn't it? Like, finally, you can get a slice of those superior returns the big institutions have been feasting on for years.
Exactly. It sounds so fair, so overdue.
But our mission today is, well, to step back from that marketing hype. We want to do a kind of forensic analysis, really digging into a sharp critique from veteran financial columnist Jason Zweig.
A voice many listeners will know. Very respected.
Absolutely. And we're trying to extract the core insight from his work that explains why those barriers existed in the first place. Why weren't retail investors involved before? And maybe why removing those barriers might actually be more dangerous than helpful for the individual.
Okay, let's try and unpack this with some real precision. Because the common story, the narrative you hear, is that the barrier was just about money, the price of entry. If you had enough cash, you could get in.
Right, that's the simple story.
But Zweig's argument, the one we're focusing on, it's much more structural. And honestly, it's a bit more unsettling.
Mm-hmm.
The core idea, his thesis, is this. It was never just about the money. He says, quote, it's about muscle.
That phrase really nails it. Muscle. That's the essential insight. Because size, having that institutional scale, it confers distinct real advantages in this asset class.
Okay, so what kind of advantages are we talking about? What does muscle translate to in practice?
Well, think about it. Superior negotiation leverage when you're setting up the deal. The ability to achieve true diversification because you can invest significantly in many different funds, not just tiny slices.
Right.
And maybe the most critical point, the sheer ability to manage the inherent illiquidity. The fact you can't just sell these things easily.
Right, the lockups.
Exactly. And these are advantages that a fragmented solo investor, even someone with, say, a seven-figure net worth, they simply cannot replicate that.
So they might have the cash to get through the door now.
They might, but they absolutely lack that institutional strength, the muscle to get good terms, or crucially, to get their money out when they actually need it. That's the key difference.
And this isn't just some theoretical debate, is it?
Right.
This shift is happening at a massive scale. Systemic, almost?
Oh, absolutely. Private funds globally, the estimates are around $13 trillion now. 13 trillion.
Wow.
And just in the U.S., the money flowing from retail investors, individual investors into these illiquid assets, it's surged up something like 300% just since 2020.
300%. That's staggering growth.
It is. So this isn't some niche market anymore just for, hedge fund enthusiasts playing around. This is weaving its way right into the retirement security of millions of people.
Which makes understanding these structural risks just absolutely vital right now, before more people jump in, perhaps, without fully grasping the dangers.
Exactly. It's a critical moment.
Okay, so if we're going to understand why this is happening, we have to start with the psychology, right? The allure. Why are individuals flocking to this space now?
Yeah, you have to acknowledge that pull. It's strong, and it's largely driven by, well, a decade of ultra-low interest rates, frankly, plus that deep-seated fear of missing out, FOMO.
Oh, definitely FOMO. The pitch is almost irresistible, isn't it? I mean, think back just a few years. Treasuries yielding, what, 2%, sometimes less?
Barely anything. Safe, but yielding nothing.
And then you see these pitches promising 10%, 15% annualized returns, the kind of returns institutions have supposedly enjoyed for years. It feels like you found some kind of financial cheat code.
It totally does. And it feeds directly into that really powerful, widespread feeling that the whole financial system is kind of rigged against the little guy.
Right. The institutions get the good stuff. I get the scraps.
Exactly. So the logic follows, well, the only way for me to make up ground to get ahead is to step outside the boring old public market stocks and bonds and chase those higher returns that were previously locked away.
Access. It's all about getting access to the good stuff.
But that chase for yield, it completely obscures the fundamental operational reality of these assets, how they actually work, or maybe how they don't work when you need them to.
Okay, so before we go deeper, maybe we should just pause and get crystal clear on the definition. When we say private funds, what exactly are we talking about here?
Good point. Yeah, let's be specific. We are definitely not talking about your regular stocks traded on the New York Stock Exchange or ETFs you buy through your broker.
Things you can buy and sell any weekday.
Exactly. These are investments that do not trade daily on an exchange. So we're talking about things like private equity that's buying, managing, and eventually selling companies that aren't publicly listed.
Okay.
Venture capital funding early stage startups, hoping for the next Google. Private credit that's lending money directly to companies, bypassing the public bond market.
Direct loans.
Right. And also certain kinds of large-scale closed-end real estate funds. Big property deals.
Got it. And the key characteristic across all of these different types.
The common thread, inherent illiquidity. You can't easily sell them. And often pretty opaque valuation processes. It's hard to know exactly what they're worth day to day.
That illiquidity, the inability to sell quickly, that seems to be the structural weak point.
Yeah.
And Zweig argues this is where the behavioral side really kicks in hard for individuals.
It really does. He points to this recent CFA survey from 2025. It found something pretty staggering.
What's that?
70%. 70% of individual investors fundamentally underestimated the risks tied to lockup periods.
70% just didn't grasp how long their money could be tied up or what that meant.
Exactly. That is a massive failure of risk perception. They're often looking at these things, these illiquid assets, not as potential ticking time bombs in a downturn, but rather as these steady, stable diversifiers. Because, the price isn't jumping around every minute on their screen.
Right. If the price isn't quoted constantly, people subconsciously assume it isn't changing much. It feels less risky than a stock bouncing around.
That cognitive bias is so dangerous. It creates this totally false sense of stability. Your public stock portfolio might swing 5% in a day, and it causes panic, right?
Yeah, headlines everywhere.
But a private fund valuation might stay flat on paper for 6 months, and the investor thinks, oh, great, this is stable. When in reality, the valuation is just stale. It hasn't caught up with reality yet.
And when reality does hit, like in a real financial crisis.
Well, illiquid assets only behave in one predictable way when things get truly ugly. They freeze up. They become impossible to sell at anything close to a fair price.
And the big institutions, they know this, right?
Oh, absolutely. Institutions like, say, the Harvard Endowment or CalPERS, the big California pension fund, they understand this fundamental physics. They have effectively permanent capital bases. Their time horizon isn't 5 years, it's 50 or 100.
So they can afford to wait out a downturn.
They can absolutely absorb a required 7 to 10 year lockup period, or even longer if a fund needs to wind down slowly. They just wait it out. But the typical retiree, or even a, moderately wealthy person managing their own money, they don't have permanent capital.
Their time horizon is finite, especially once they stop earning.
Exactly. Particularly in retirement, that clock is ticking.
Okay, let's circle back to that core thesis, the muscle. What does institutional scale, that muscle, actually buy you besides just getting in the door? Can we get specific about the negotiating power that retail investors completely lack?
Yeah, let's nail that down. When a big institutional limited partner, let's call them an LP, say a $20 billion pension fund, commits a serious chunk of change, maybe $100 million or more, to a single private equity fund.
Okay, big check.
They instantly get priority status. They're not just another investor writing a check. They become a critical strategic partner for the fund manager, the general partner, or GP.
And that status gives them power.
Absolutely. This power lets them demand and receive customized terms, things that aren't in the standard contract everyone else signs. These are usually written down in what's called a side letter to the main limited partnership agreement, the LPA.
A side letter. So like secret extra terms just for the big guys. Can you give an example? What kind of term protects an institution that someone using an online platform just wouldn't get?
Sure. A really common one is around priority liquidity queues and transparency. For instance, institutions can negotiate clauses that say, if the fund suddenly needs more money from its investors, a capital call, The institution gets deeper, more frequent updates on how the underlying investments are really doing, much more than standard LPs get.
More information.
More importantly, in times of stress, when everyone wants their money back, they can negotiate preferred redemption priority. They get to the front of the line in the fund's payout system, the waterfall we'll talk about later.
Front of the line access.
Or at the very least, they might secure excuse rights. That lets them opt out of certain new investments the fund makes if they look too risky, or even opt out of putting more money in during a capital call.
Wow. Okay, so they have outs that small investors don't.
Completely. Retail investors coming in through one of these online platforms or maybe an aggregated feeder fund, they're all just lumped together. They have zero ability to negotiate terms. They can't demand extra reporting. And they certainly cannot secure a spot at the front of the liquidity line.
They just get the standard contract. Take it or leave it.
Exactly. It's a boilerplate contract, often hundreds of pages long, probably barely read, offered on a take-it-or-leave-it basis. They are fundamentally price takers and rule followers, the institutions. They're rule setters.
So even if the individual investor scrapes together the, say, $250,000 minimum the platform requires, the real structural difference isn't the dollar amount itself. It's the total lack of legal and operational bargaining power. The second they sign that standard agreement, they've basically given up any leverage they thought they might have had. They're just part of a crowd of fragmented, powerless, small investors.
That's it, exactly. They are small fish in a pond where the fund manager, the GP, is really focused on keeping the sharks happy.
The big institutional LPs.
Right. The GP's loyalty, their attention, their best terms, it's always going to be directed towards the LPs who can write the next $500 million check for their next fund, not the individual who came in with $100K via some online aggregator.
That power imbalance. It's like an unseen tax, isn't it? The price the small investor pays for getting access.
That's a great way to put it, an unseen tax. And we really need to keep that huge, legally codified power imbalance in mind as we move into the core story of this deep dive, the case study's wide details about Daniel Perlin.
Right. This is where it gets real.
This is where Zweig takes that abstract idea of a structural flaw and makes it just devastatingly, painfully concrete in financial terms.
Okay, the story of Daniel Perlin. And that's a pseudonym, right, to protect his privacy.
Yes, exactly. It's really the anchor for Zweig's entire argument, and it's filled with this tragic irony. Because Perlin wasn't some naive saver who didn't know anything about finance.
No, far from it. He was a former high-level executive at Vanguard. Vanguard, one of the world's biggest, most trusted asset managers. And his specialty, bond funds.
Yeah, he had managed billions of dollars. His actual job involved engineering liquidity into complex public market products, making sure investors could get their money out of bond funds when needed. He lived and breathed liquidity management for a living.
The fact that even a finance pro like him, someone who understood massive fund structures inside and out, could get trapped by the rules of the private market. Well, it really proves that knowing public markets doesn't protect you here, does it?
Not at all. It offers zero inoculation. His downfall wasn't because he lacked knowledge. It was purely down to that structural asymmetry we talked about. The rules are just different.
So what happened? He retired around 2020.
Yeah, retired around then. And he immediately faced that notorious zero interest rate environment, ZIRP. Everything safe yielded basically nothing.
A tough time for retirees needing income.
Extremely tough. So, like many others, he was lured by those pitches promising 8%, 10%, maybe 12% returns from private funds. Income generation that his old safe world of traditional bonds just couldn't deliver at that moment.
So he decided to take a calculated risk.
Yeah.
He allocated about 15% of his portfolio, which is a substantial amount for him, around $300,000 into private funds through one of these online platforms.
Right, a significant bet.
Let's focus on what was promised initially. The platform marketed this as institutional-grade access, right? And the terms, when he first looked at them, they seemed okay, maybe even relatively safe.
On the surface, they did. The key terms that probably gave him some comfort were things like a 60-day notice period for redemptions. You ask for your money, you wait 60 days. Seems reasonable.
Okay.
And they had what are called soft gates. These rules theoretically allowed up to, say, 15% of the fund's total assets to be withdrawn by investors each quarter.
So the thinking is, okay, 60 days notice, and the fund can handle outflows up to 15% each quarter. If I need my money, that sounds like enough capacity.
It gives you a sense of security, right?
A completely false sense of security, as it turned out, because that theoretical safety is precisely what makes the actual failure so jarring when it happens.
So fast forward to early 2023, what happened?
Perlin found himself needing $50,000. Not, his whole investment, but a critical chunk of cash. It was for unexpected, urgent medical bills.
Oh, wow. Okay, so exactly the kind of real-life event that savings are meant to cover. Sequence risk meets a sudden need. The absolute definition of it. The very thing retirement savings are supposed to protect you against. So he followed the rules. He submitted his 60-day redemption request for the $50,000.
Right.
And that's when the financial quicksand just opened up beneath him. His request triggered this catastrophic cascade of deferrals and denials. Remember, he'd spread his $300,000 across 3 different private funds on that platform.
Diversification, he probably thought.
Right. But all 3 failed him, each in a structurally distinct way, but all equally devastating when he needed the cash. This story is basically the blueprint for how retail illiquidity risk plays out in reality.
Okay, let's break it down fund by fund. Failure number 1 was his direct lending fund. What excuse did they give for just rolling over his request, ignoring the 60-day promise?
Right, the direct lending fund, this was basically a pool making loans directly to medium-sized businesses. They told him they couldn't honor his request because of unmet capital calls from the companies they'd lent money to.
Unmet capital calls. What does that mean in plain English?
Think about early 2023. Interest rates were rising sharply. That put enormous stress on many of the highly leveraged private companies the fund had lent to.
So those companies were struggling to pay the fund back.
Exactly. They were maybe missing interest payments, or they needed emergency cash injections from the fund just to stay afloat. Now, the fund manager, the GP, their primary legal duty, their contractual priority, is always to protect the fund itself and its underlying investments, the companies they lent to. It's not to manage the liquidity needs of their investors, the LPs like Perlin.
The fund comes first, not the investor needing cash.
Always. So they invoked a clause buried in that long LPA, the contract, that allowed them to just roll over his entire redemption request to the next quarter, basically saying, sorry, we don't have the cash right now because our borrowers need it, and the contract says we can make you wait.
Wow. So delay number 1. His 60-day expectation completely shattered right there.
Gone.
Okay, so delayed, but maybe there's still hope for the next quarter. What about fund number 2? He had money in multifamily housing fund too, right?
He did, and this one introduced a much more sinister kind of illiquidity problem. This housing fund had apparently been hit hard by a wave of tenants defaulting on rent, plus general stress on property valuations at the time.
Okay, so also under pressure.
Definitely. So when Perlin asked for his share of the $50,000 from this fund, they actually agreed, but only partially. They said they'd give him only 40% of what he asked for from that fund, let's say $20,000 of his $50 total request in actual cash.
Okay. Only 40%. What about the other 60% he needed? Where was the rest of his money?
This is where it gets really bad. They proposed to deliver the remaining 60% not as cash, but as an in-kind distribution.
In kind? What on earth is that?
It means instead of giving him money, they gave him ownership of a tiny fractional piece of one of the actual underlying illiquid assets in the fund, like a microscopic stake in one of the distressed apartment buildings they owned.
Wait, so instead of cash for his medical bills, they gave him a tiny slice of a building that was probably having financial problems itself.
Exactly. It sounds very professional and technically correct on paper, in-kind distribution. But for a retiree who needs, say, $30,000 in cash right now to pay a hospital, it's completely useless.
Worse than useless, maybe. Is he now responsible for that little piece?
Potentially.
Yeah.
He was essentially handed a fractional ownership stake in a troubled piece of real estate, maybe saddled with future liabilities, and with absolutely no easy way to turn it back into cash.
Let's just zoom in on that for a second. The logistical nightmare. If he gets this in-kind piece of property, what does Perlin actually have to do now to get the cash he originally needed?
Well, he basically has to become an active manager of this tiny, likely depreciated share of some specific property somewhere. He'd have to somehow find a buyer on the secondary market, if one even exists, willing to purchase this microscopic sliver of illiquid real estate equity or debt.
That sounds impossible, or at least incredibly difficult and expensive.
It's a total administrative and legal nightmare. It would likely involve bespoke transactions, months of searching, huge legal fees, massive discounts. The fund basically just offloaded their problem asset onto the small, distressed investor. They swapped fungible currency cash for a non-fungible, non-marketable legal headache. It completely defeated the entire purpose of his redemption request for urgent cash.
That's appalling. Okay, so Fund 1 delayed him. Fund 2 gave him part cash and part useless property stake.
Yeah.
What about the third one, the bridge loan fund? Any better luck there?
Nope. Worse, actually. The bridge loan fund, which probably made short-term loans for things like property development, they just froze redemptions entirely. Full stop.
Completely.
Completely. They cited secondary market freezes, meaning their own ability to sell off the underlying loans they held to generate cash for redemptions had just evaporated. The market for those loans seized up, so that soft gate we talked about, the 15% quarterly outflow, it didn't just bend, it shattered and slammed shut. Total freeze. Zero access.
This whole sequence, it's just a perfect, brutal illustration of what you called illiquidity asymmetry, isn't it?
Absolutely. The funds demand capital from their investors, the LPs, via capital calls whenever they need it. But when the LPs need liquidity from the fund, suddenly it's entirely optional, subject to market conditions, GP discretion. Basically, tough luck.
The contract enforces one-way traffic. Capital flows in easily, but getting it out is conditional.
And that's the structure.
So after all this, months of agonizing waiting, juggling these 3 different rejections and partial payments, what was the final financial outcome for Perlin? Did he ever get the cash?
Partial funds did eventually trickle in, but it took 6 months. 6 months after his initial 60-day request.
6 months.
And by the time the cash arrived, the valuation of the underlying assets in those funds had been marked down significantly, like 20% to 25%.
Why the markdown?
This is during that period of stress around the regional banking crisis in 2023. It forced a kind of temporary reckoning for private valuations, which had probably been kept artificially high. The stress testing models got tougher, forcing markdowns.
Okay, so the value dropped while he was waiting. How much did he actually get in the end compared to the $50,000 he needed?
When the dust finally settled, after 6 months, he netted only $38,000 on his original $50,000 request.
$38,000. So he got $12,000 less than he desperately needed 6 months late after immense stress. But wait, I have a feeling the story gets even worse. It does, doesn't it?
Oh, it does, unbelievably. Not only was the amount short and incredibly late, but the platform or the funds actually charged him a 1.5% acceleration fee.
An acceleration fee? For what? For accelerating a process that took 6 months and still failed to deliver the full amount? That sounds predatory.
It sounds utterly perverse, right? But that's the general partner using the deep, dense fine print of the limited partnership agreement, the LPA.
How could they possibly justify that?
They likely define their standard redemption process in the contract as being incredibly slow and protracted, maybe even annual. So anything that deviates from that snail's baseline process, even if it's delayed 6 months by market conditions they couldn't handle, can, under the terms of the agreement he signed, be legally deemed expedited, and therefore subject to a penalty or a fee.
So they penalize him for their own failure to provide liquidity.
It's a stunning textbook example of how the GP can use the opaque legal framework, the contract, to benefit themselves directly at the expense of the fragmented, less powerful investor, even when that investor is clearly facing genuine financial distress.
The fact that Perlin, a former Vanguard exec, felt he had to spend $5,000 on a lawyer just to try and fight these terms, only to find out he had absolutely zero leverage against the fund manager, that, for me, is maybe the most damning indictment of this whole structural problem. His accredited investor status, his financial sophistication, meant nothing.
Absolutely nothing. That status, being an accredited investor, it's really just a wealth or income hurdle. It provides zero practical protection, zero negotiating power against the general partner once you've signed the LPA. The contract was the final word. And because Perlin had no scale, no muscle, he was powerless to challenge it.
What did he end up doing for the medical bills?
He eventually had to resort to using high-interest personal loans to cover the shortfall and bridge the gap while he waited, which, of course, just eroded his carefully planned retirement nest egg even further.
Just awful. His quote that Zweig includes really captures it, doesn't it? It's like being stuck in quicksand. You pull harder and it sucks you deeper.
It perfectly captures that feeling. Trying desperately to access your own capital, only to find yourself penalized and sinking further into trouble for the very attempt.
And the ultimate irony, the point he made reflecting on his old job.
Yeah, the contrast he drew as a former Vanguard executive is just so sharp. He said something like, "At Vanguard, we engineered liquidity into everything we built. It was fundamental. In privates," he said, "liquidity feels like an afterthought, if it's thought of at all." That fundamental shift in philosophy from liquidity being a mandatory design feature to liquidity being an optional managed outcome, that is the absolute heart of the risk that individual investors are taking on, perhaps without realizing it.
And critically, this isn't just one unlucky guy, one bad fund, right? Zweig backs this up with broader data.
Yeah, he uses data from Prekin, a big private market data provider, to put Perlin's nightmare into context. And the numbers are stark. Retail private fund redemption failures, meaning requests that were denied, partially filled like Perlin's, or significantly deferred beyond the promised time frame, hit 25% in the 2023-2024 period.
1 in 4. 1 out of every 4 redemption attempts by a retail investor basically failed.
Failed or was severely impaired. And get this, that failure rate was 3 times higher than the rate experienced by institutional investors during the same period.
3 times higher for retail. Why? What's the mechanism there?
It comes back to muscle and structure, because those smaller retail commitments, both by the letter of the contract and just by the practical reality of the GP's priorities, they lack priority in the fund's distribution waterfalls. They are structurally, intentionally, the last in line when cash gets tight.
Okay, that 25% failure rate for retail, 3 times the institutional rate. That really demands that we dig deeper into why. Let's start with those GP waterfalls you mentioned. Can we get a clear, maybe non-jargony explanation of how this contractual hierarchy works and why it puts the small investor dead last?
Sure. Think of the waterfall like a financial triage system. It dictates who gets paid, in what order, whenever the fund has cash coming in, maybe from selling an investment or just regular income. And crucially, it also dictates the priority list when the fund is under stress and needs to distribute limited cash.
Okay, a priority list.
Oh.
Who's at the very top? Who gets the first drops from that waterfall?
Well, surprise, surprise, the general partner of the GP always ensures they get paid first. Their management fees, the fund's operating costs, got to keep the lights on right. That comes right off the top.
Okay, GP gets paid first. Makes sense. Who's next in line?
After the GP takes their cut, they then prioritize payouts or redemptions for their largest, most strategically important limited partners, the institutions, the whales.
Why them specifically?
Pure business logic. The long-term survival and success of the GP's entire business depends on raising their next fund, Fund 6 or Fund 7. And to do that, they absolutely need to keep those huge pension funds and endowments happy. They cannot risk upsetting a massive institution that might commit, say, $500 million to the next fund just because they stiffed them on a $10 million redemption request today.
Okay, so the big guys get priority to keep them sweet for future business.
Yeah.
Where does that leave the individual retail investor who came in via the platform?
At the bottom. If there's only a limited pot of cash available during a stressful period, maybe enough to meet only half the redemption requests, the GP will absolutely prioritize fulfilling that $100 million endowment's $10 million request over fulfilling a solo saver's $50,000 request, even if both requests were technically submitted on time and fall within that theoretical soft gate limit.
So the soft gate isn't really a guarantee, it's more like a suggestion, subject to the GP's priorities.
It's subject to the waterfall priority. It's a business decision for the GP, rooted entirely in scale and future fundraising potential. The smaller retail investor, effectively, ends up serving as the fund's most patient capital, or maybe more accurately, their most trapped capital.
Because they have the least power to complain or pull future investments.
Exactly. They provide a stable, sticky capital base that the GP can kind of rely on, knowing that these investors have the least ability to challenge delays or exits. So naturally, they become the lowest priority when cash gets tight. Last in line.
This brings us right back to that crucial difference in time horizons we touched on earlier. The concept Zweig highlights illiquidity, asymmetry, and sequence risk. The huge gap between a perpetual institution and a finite retiree.
It's the absolute critical distinction. A large endowment, like Yale's or Harvard's, operates in perpetuity, forever, basically. If their private equity portfolio is down 20% on paper this year, it's painful, but they just wait.
They don't need the cash flow immediately.
Right. They have the financial endurance, the time to let those assets recover, mature, and eventually, hopefully, sell at a profit years down the line. They're measuring success over decades, 30, 50 years or more.
But a retiree, maybe someone in their late 60s or early 70s, especially in those first crucial years of retirement, they don't have 30 years to wait for a portfolio recovery, do they?
Absolutely not. And that's sequence risk hitting hard. Sequence of returns risk is the danger that if you're forced to sell assets at a loss early in your retirement, you lock in permanent damage to your portfolio. You lose the crucial time needed for that capital to recover because you're drawing money down, not building it up anymore.
Like Perlin needing that $50.
Yeah.
If the market had been even worse and his assets were marked down 40% when he needed the cash.
That 40% loss becomes permanent for that chunk of capital. He can't just wait for it to bounce back because the medical bill needs paying now. That loss of time, that inability to wait out the cycle, that's the critical asset the institution possesses that the individual retiree fundamentally lacks.
And Zweig actually tried to quantify the impact of this.
He did. Using Monte Carlo simulations, those are statistical models that run thousands of possible market scenarios. His analysis showed the potential drag is really extreme. He found that taking just a 20% haircut on a relatively small 10% allocation to private funds.
Okay, 10% allocation, 20% loss on that slice.
That event could potentially wipe out the equivalent of 5 to 7 years worth of income you might have expected from sticking with conservative bond investments.
Wow. Years of income gone from one bad sequence event in a small part of the portfolio.
Exactly. You're sacrificing potentially years of steady, reliable income from the safer part of your portfolio just for the chance of higher returns from that illiquid slice. Returns that might completely fail to materialize precisely when you need the cash. It's a terrible trade-off for many retirees.
Okay, so the illiquidity risk is huge. The asymmetry is stacked against the individual. If the whole premise of bothering with private funds is those supposedly superior returns, well, that performance needs to be pretty spectacular to justify all this risk, the lack of transparency, and designry. Let's talk about the fees. The fee drag must compound the pain here.
Oh, absolutely. The fees are a constant headwind, even before you factor in the illiquidity risk. The standard structure, the one you hear about most often, is the 2 and 20 model.
Right. 2 and 20, what does that mean?
It means typically a 2% annual management fee charged on the total capital you've committed to the fund, whether it's invested yet or not. And that's paid every year, regardless of performance. Good year, bad year, you pay 2%.
Okay, 2% off the top, every year. On a billion-dollar fund, that's $20 million a year straight to the manager just for showing up. That already sounds high compared to, say, an index ETF charging maybe 0.05%.
It's vastly higher. But the really crucial part, the part that adds insult to injury, is the 20 part. That's the carry, or carried interest. It means the GP also takes 20% of the profits the fund generates above a certain minimum return level, the hurdle rate.
Okay, 20% of the profits. Sounds fair if they perform well.
It sounds fair, but the devil is in how those profits are often calculated, especially before the fund is fully liquidated.
How so?
That 20% carry is frequently charged on paper gains, unrealized profits. Unlike a public fund, like a mutual fund or ETF, which uses a daily market price, usually verified by a neutral third-party custodian.
Right, you know the price every day.
Private funds rely heavily on internal valuation models run by the GP themselves. These models are inherently subjective, they're prone to inertia, meaning they change slowly, and frankly, they are often deliberately slow to reflect deteriorating market conditions or write down assets.
Why would they be slow to mark things down?
Well, think about it. If your management fee is 2% of assets under management and your carry is 20% of profits, you have a very strong incentive to keep those asset values and paper profits looking as high as possible for as long as possible. Marking assets down reduces your fees.
So the general partner, the GP, is effectively collecting their 2% management fee based on asset values they largely determine, which might be temporarily inflated.
Right.
And they might also be collecting 20% of profits that only exist on paper based on their own internal, often unaudited estimates of value.
That's the potential conflict right there. It creates this massive information gap compared to the public markets world. Public funds operate under very strict, standardized SEC rules. The Investment Company Act of 1940, 40 Act, rigorous transparency, audited financials, daily pricing.
But private funds don't have that same oversight.
No, they operate under bespoke, often confidential, limited partnership agreements, LPAs. These are complex legal contracts designed primarily by and for the benefit of the general partner. And the research that Swag cites from a group called Arbitrage Monitor shows a direct consequence of this.
What did they find?
They found that when these retail platforms inevitably gloss over the crucial downside protection clauses buried deep in the LPA, because let's be honest, who reads a 200-page legal document?
Right, you get the glossy marketing summary.
Exactly. When those crucial terms are downplayed or misunderstood, it leads to dispute rates between investors and managers that are 30% higher for retail investors compared to institutions.
30% higher disputes. That jump seems like it must be purely because the retail investor, unlike the big institution, just doesn't have the army of lawyers, the leverage, or maybe even the financial sophistication to really vet those complex contracts up front or to effectively challenge the GP's decisions later.
It's a massive resource mismatch. For a big pension fund, getting into a legal dispute over LPA terms is just a cost of doing business. They have in-house legal teams, huge external counsel budgets, they can handle it.
But for an individual.
For an individual investor, hiring an expensive law firm to fight a multi-billion-dollar private equity GP over maybe a $50,000 redemption issue like Daniel Perlin tried to do, it just quickly becomes financially completely inefficient, not to mention emotionally draining and incredibly stressful. You're outgunned from the start.
We've talked a lot about this sort of average accredited investor, maybe the retiree. But Zweig also points out that even properly wealthy individuals, people with, say, $5 million, $10 million, maybe up to $50 million in assets, they also fall into what he calls the scale trap. Why would someone with, say, $20 million still suffer from these structural disadvantages? They have significant money.
They do have significant money, but even $20 million is still fragmented capital in the grand scheme of the private markets universe. It's not enough to get them treated like a major institution.
So they can't write that $100 million check to get into the absolute top-tier, best-performing funds with the best terms.
Exactly. They typically don't get access to the KKR main fund or the Blackstone flagship vehicle. Instead, what they end up doing is putting smaller amounts, maybe $1 million or $2 million, into many different funds run by many different GPs, often 20, 30, sometimes even 50 different fund commitments.
That sounds like diversification, though. Isn't spreading the money around like that a good thing? Reduces risk.
You'd think so, but it leads to what Zweig calls over-diversification without actual risk reduction. They might end up with tiny stakes in hundreds, maybe over 100 underlying portfolio companies across all those funds.
Okay.
But they haven't actually diversified away the main risks we've been talking about, the fundamental illiquidity, the opaque valuations, the high fees, the GP-friendly contracts. Those risks are embedded in all the funds.
So they just have the same core risks, but spread across more managers?
Precisely. And what they have done is massively inflate their own operational complexity and due diligence costs by maybe 5 to 10 times compared to just buying a few public ETFs.
How so?
Think about it. Now they, or their advisor, has to try and vet 50 different private fund managers. They have to track 50 different K-1 tax forms every year, which are notoriously complex. They have to monitor 50 different LPAs and capital call notices. It becomes a massive administrative burden, a huge time sink, and a significant financial drag from advisory fees or just their own time.
Whereas a big endowment just hires a dedicated internal team to manage their maybe 10 large private equity relationships.
Exactly. The high net worth individual is caught in the middle. They're too big to just ignore private markets, maybe, but they're way too small to access them efficiently or negotiate like a true institution. They get the complexity without the clout.
Okay, let's pull the camera back now, look at the bigger picture.
Okay.
If this trend of retail money pouring into private funds keeps going at this pace, I mean, the projection mentioned is potentially $1 trillion in retail AUM by 2030.
Yeah, that's a commonly cited projection, $1 trillion.
If that happens, this stops being just a story about individual investors like Daniel Perlin getting hurt, right? This starts to potentially introduce real systemic fragility into the entire financial ecosystem.
That's the critical connection that regulators and sophisticated observers are increasingly worried about. It's the potential for spillover. When you combine massive pools of inherently illiquid assets with a growing base of investors who might have shorter time horizons, lower tolerance for losses, and a sudden correlated need for cash, like Perlin did.
Like in a recession or a market panic.
Exactly. You introduce the very real risk of severe liquidity spillovers that don't just stay contained within the private markets. They can actually destabilize the public markets too.
Okay, I think we need to trace that mechanism really clearly. How does, say, a private credit fund freezing redemptions for its retail investors directly cause instability in my plain vanilla S&P 500 index fund? That link might not seem obvious.
It's often an indirect, but still very powerful chain reaction. Think about it from the private fund manager's perspective. When they suddenly need to raise cash fast.
Why would they need cash fast?
Well, maybe to meet a surge in unexpected redemption requests from their investors, like Perlin's multiplied by thousands. Or maybe even more commonly, they get a sudden, urgent capital call from one of their underlying portfolio companies that's struggling and needs an emergency cash injection.
Okay, so they need cash now, but they can't easily sell the private loans or the private company stakes, right? Those are illiquid.
Exactly. Those assets are locked up, or selling them quickly would mean taking a massive haircut, a fire sale price. So what do they sell when they need cash immediately?
They sell whatever they can sell easily, their most liquid holdings.
Precisely. They are forced to liquidate their public market assets. Things like high-quality corporate bonds, maybe government bonds, broad market index ETFs, blue chip stocks that they might hold in a liquidity sleeve. This is what traders call correlation going to one in a crisis.
Everything gets sold together, regardless of quality.
Right.
When stress hits hard, the managers are forced to sell their best, safest, most liquid holdings simply because those are the only things they can sell quickly to try and raise the needed cash. And when many managers do this at the same time, it obviously depresses the prices of those very public assets.
Is there evidence this actually happens?
Yes. During that mini crisis in 2023, the one related to the regional banking stress, some estimates suggest there were approximately $50 billion worth of such forced unwinds from private funds selling public assets.
$50 billion, that's not insignificant. That's real selling pressure in the public markets, triggered by problems in the private sphere.
It's definitely significant, and analysis suggests that that selling pressure contributed directly to some of those sharp, maybe 5% dips we saw in broader public market indices during that period.
So the irony is, the retail investor who bought into private funds, maybe hoping for diversification away from public market swings, ends up potentially contributing to more volatility in the very public markets where the vast majority of their other retirement savings, like their 401k, are likely held. The illiquidity problem in one corner of the market doesn't stay contained. It spills over and introduces instability across the whole system.
And this changing investor base, this influx of potentially less patient retail money, it must also force the fund managers, the GPs, to change how they operate strategically, doesn't it?
Absolutely. It has to. General partners are now managing a much more diverse, much more fragmented base of limited partners than they ever did before. And many of these new LPs, the retail crowd, have arguably demonstrated a much lower tolerance for deep, prolonged illiquidity.
They panic more easily, maybe.
Or just have more genuine shorter-term cash needs. This creates real managerial tension for the GP. They might become much more worried about the prospect of a run on their retail-focused funds if, say, the economy takes a sharp downturn or another crisis hits.
So how does that fear change their behavior in the real economy?
Yeah.
What do they do differently?
Well, they might become much more risk-averse about deploying capital. They might feel compelled to impose stricter rules across the board, maybe universal fund life extensions, or enacting higher, tougher redemption gates for everyone, even their big institutional LPs, just to manage the potential volatility coming from that retail segment.
So the presence of retail investors could actually make things worse for the institutions in the same fund.
It could. And this caution, this need to hold more cash back, slows down the whole capital recycling engine of private equity. If GPs are afraid to actually invest the money they've raised because they need to keep massive cash buffers on hand just in case redemptions spike.
Then less money goes into buying companies, funding projects.
Exactly. M&A activity slows down. We saw it was already down about 15% in 2025, according to the outline. You risk having this huge pile of dry powder that's capital that investors have committed, but the GP hasn't actually invested yet, maybe $4 trillion globally.
$4 trillion sitting on the sidelines.
Potentially sitting idle or being deployed much more slowly simply because managers are paralyzed by the fear that a sudden retail redemption spike will force them into those messy, value-destroying public market unwinds we just discussed. So, ironically, the influx of retail money could actually slow down the very economic activity that private markets are supposed to fuel.
Okay, so if the market itself isn't correcting these issues efficiently, or if the side effects like those $50 billion unwinds are just too painful for the broader system, then you'd expect regulators to step in. These horror stories, like Daniel Perlin's, they must be exactly the kind of thing that fuels calls for regulatory action.
Absolutely. They provide the political impetus. And we are already seeing the landscape start to shift. Recognizing the growing risks and the need for better guardrails, SEC Chair Gary Gensler initiated some private fund reforms back in 2025.
What was the main thrust of those reforms?
Primarily, they focused on mandating more transparency, requiring things like standardized quarterly reporting of fees, expenses, and performance across all private funds.
The idea being, if valuations and fees have to be reported more frequently and consistently, using standardized methods.
It reduces the ability of GPs to kind of smooth returns or hide fees or keep those paper gains looking high indefinitely. It forces a level of regular scrutiny that starts to look a bit more like the public markets.
Okay, more transparency. Good step. But does that actually fix the core illiquidity problem for someone like Perlin?
Many argue it doesn't, really. Transparency is good, but it doesn't magically make an illiquid asset liquid when you need cash. So the discussion, particularly among investor advocates, inevitably turns towards potentially adopting stricter, more direct standards, perhaps mirroring what Europe has done.
Right, the European model, what does that involve?
There's growing discussion and some pressure to potentially move towards rules similar to the EU's Alternative Investment Fund Managers Directive, the AIFMD. In many cases, those rules effectively limit the percentage of illiquid assets that certain types of funds, especially those marketed to non-professional investors, can hold, often around a 10% cap on illiquids.
A hard cap. Not just disclosure, but a limit on how much illiquid stuff can even be in the fund if it's sold to retail.
Exactly. It's a structural limit. And if the U.S. were ever to adopt something similar, say a 10% cap on illiquid holdings for funds accessed by most individual accredited investors, the analysis Zweig references suggests the impact could be huge. It might redirect as much as $500 billion out of private funds and back into public liquid assets.
$500 billion moving back from privates to publics. That would be a massive structural reallocation of capital.
Huge. You'd likely see a significant boost in demand for highly liquid, maybe more conservative public assets, things like bond ETFs, high-quality stocks. It would essentially force liquidity back to where it structurally belongs for investors who need it, easily traded instruments, and arguably reduce some of that systemic risk we talked about from having too much capital stranded in illiquid holdings accessible by potentially flighty investors.
Now, while regulators contemplate stricter rules, the financial industry itself is, of course, trying to innovate its way around this problem, right? Creating these retail-friendly hybrids. Things like interval funds, liquid alternatives, liquid alts. There's a projection of $300 billion flowing into those by 2028. Are these the answer? Do they solve the liquidity puzzle?
Well, they're definitely an attempt to square the circle, to offer the potential returns of private assets, but packaged in a structure that offers some level of defined liquidity.
How do they typically work?
Usually, interval funds or certain types of liquid alts hold underlying illiquid assets, private credit, real estate, maybe infrastructure, but the fund structure itself commits to offering liquidity to its own shareholders, often on a quarterly basis, usually through periodic tender offers, where the fund buys back a limited percentage of its own shares.
Okay, so it's better than a hard 7 or 10-year lockup. You get a chance to get some money out each quarter, maybe.
It's arguably a slight improvement over a complete hard lockup, yes, but it still doesn't change the fundamental physics. They are still subject to immense stress in a crisis.
Meaning, if the underlying private assets freeze up, or if too many investors rush for the exit at once, that quarterly liquidity window, that tender offer, it's really just another form of softgate, isn't it?
Okay.
It can still be suspended or dramatically reduced.
Absolutely. If the fund manager can't sell the underlying illiquid assets to raise cash for the tender offer without taking huge losses, they will almost certainly invoke clauses to limit or suspend those quarterly redemptions. We saw this happen in various liquid alt sectors during past stresses.
So it doesn't eliminate the risk, it just changes the timing or the mechanism of how the liquidity might fail you.
Exactly. And this brings us right back to Zweig's fundamental skepticism about relying on technology or financial engineering as the ultimate solution here. People talk about using blockchain for secondary trading of private fund stakes, making it easier to sell your position to someone else.
Right, creating a better marketplace for illiquid stuff.
Maybe. But as Zweig cautions, and I think it's a really critical quote, technology fixes plumbing, not the physics of locked capital.
Technology fixes plumbing, not physics. Meaning,
you can make the process of trying to trade an illiquid asset smoother, faster, maybe cheaper. That's fixing the plumbing. But if the fundamental asset itself is that private company loan, that half-finished office building is inherently hard to value and hard to sell quickly, especially in a crisis, no amount of fancy financial engineering or blockchain tech can make it magically liquid when 25% of the investors are suddenly trying to redeem their shares all at once. You haven't changed the underlying physics. You've maybe just shifted the liquidity risk into a slightly more defined but still potentially fragile quarterly window. The core problem remains.
okay, we've covered a lot of ground here, painting a pretty detailed and frankly quite sobering picture of the risks. But the whole point of doing these deep dives is to equip you, the listener, with actionable knowledge. So let's try and synthesize all this analysis down into some practical directives for the individual investor thinking about this space.
Absolutely. And maybe the first practical step is to really internalize the cost of this illiquidity we've been discussing. Because it's not just a theoretical risk that might happen someday, it's an active, ongoing drag on your potential returns.
How so?
Well, that Vanguard study referenced in our source material tried to estimate this. They looked at the premium you effectively pay for being locked up, the higher fees you pay, often on assets that might be mispriced, and the opportunity cost of capital lost due to delayed access or forced sales at bad prices.
Right, all those friction costs.
And they estimated that this combined illiquidity drag can reduce a retail investor's net return by somewhere between 1.5% and 3% per year compared to what they might have gotten from similar but liquid investments.
1.5 to 3% annually. That might not sound like a huge number in 1 year, but compounded over a long saving period.
It's enormous. Over a typical 30-year saving and investing horizon, that seemingly small annual drag could potentially cost the average saver something like $200,000 in lost wealth by retirement.
$200,000. That's a substantial six-figure premium you're effectively paying just for the privilege of having your money locked up and potentially inaccessible.
Precisely. You need to ask yourself if the potential extra return is really worth that very real ongoing cost.
Okay, so bearing that cost in mind and remembering the structural failures we saw with Daniel Perlin, how does Jason Zweig recommend individuals navigate this tricky environment? The outline mentions 4 specific directives he considers almost non-negotiable for the solo investor.
Right. Directive number 1 is the most straightforward, the most conservative, and honestly probably the most prudent for the vast majority of people. Stick to public market alternatives.
Meaning, if you want exposure to the types of assets private equity invests in, find a liquid way to do it.
Exactly. If your main goal is just to capture the general market movement, the beta of sectors like private equity or private credit, you can actually achieve maybe 80% of that same exposure through highly liquid, publicly traded alternative without any of the lockup nightmares.
Can you give a concrete example of what that looks like?
Sure. You could look at exchange-traded funds, ETFs, that specifically track the stocks of publicly listed private equity management companies themselves. There's one ticker mentioned, PSP, that does this.
So you're buying shares in Blackstone or KKR, the public companies, not their private funds.
Right. These public companies' stock prices tend to be highly correlated with the performance of the underlying private equity market they operate in, so you get a lot of the same economic exposure, the same flavor, but with the critical advantages of daily pricing, daily liquidity through your regular brokerage account, and significantly lower management fees compared to the private funds. It's a much safer way to get similar exposure for most people.
Okay, that makes sense. Stick to liquids if possible. What's directive number 2? This one seems aimed at people who still feel compelled to invest directly in privates, maybe seeking that extra potential return, the alpha.
Yeah, if you absolutely feel you must venture into the direct private fund space, Zweig strongly advises adopting the 5% rule. Limit your exposure.
Cap it at 5%.
Maximum allocation of 5% of your total investment assets, not 15% like Perlin did, just 5%. And you need to mentally frame that 5% as the portion of your capital that you could, if necessary, functionally forget about for a decade or more. Money you absolutely do not need for living expenses or emergencies.
Okay, strict limit. And within that 5%, are all private funds equal?
No. He adds a crucial qualifier. Focus that limited 5% allocation only on funds that have genuinely proven institutional-grade liquidity mechanisms and a long track record of actually honoring them. He specifically mentions tender offer funds as potentially better structures.
Tender offer funds, like the Blackstone BCRE fund mentioned in the outline.
Exactly. Funds like that, which are structured to make regular, often quarterly, offers to buy back a certain percentage of their shares from investors at NAV, or net asset value. You need to look for funds that have demonstrated they can consistently meet those quarterly redemption requests, even through different market cycles and stress periods. Proven access is key.
That 5% limit really feels like a financial safety valve then. If that small slice goes wrong, if it gets locked up or marked down, it's painful, but it doesn't sink your entire retirement plan.
Correct. It's about strictly limiting the potential damage from sequence risk or illiquidity freezes, containing the blast radius, so to speak.
Okay, directive number 3 seems to flow directly from Daniel Perlin's terrible experience with the fine print. Demand radical transparency. since you as an individual lack the institutional muscle to negotiate terms.
You must, at the absolute minimum, fully understand the terms you are being offered before you sign anything.
And that means actually reading the contract.
It means you absolutely must review the limited partnership agreement, the LPA, before committing a single dollar. And you need to look specifically, like a hawk, for two key things buried in there: the gate clauses and the secondary sale rights.
Okay, gate clauses, what are we looking for there?
You need to find the precise language that defines the circumstances under which the general partner can block, delay, or reduce your redemption request. How much discretion does the GP have? Are the triggers objective, like a market-wide index drop, or subjective in the GP's sole opinion? If the language is vague, or if it grants the GP enormous discretionary power to shut off liquidity, that is a massive red flag. You have to be prepared to walk away. If you cannot understand the gate clause and its worst-case implications, you should not invest, period.
That sounds like a very high hurdle, though. As we discussed, these LPAs are often hundreds of pages of dense legalese, intentionally written to favor the GP. Most individuals aren't equipped to parse that.
It is a high hurdle, no question,
Sure.
but it's arguably the minimum defense the individual investor possesses. If the platform or advisor marketing the fund cannot provide you with a clear, simple, plain English summary of exactly how and when you could be prevented from getting your money back, the worst-case gate scenario, then the deal is fundamentally flawed from a retail perspective. You need that clarity.
Okay, demand transparency. Scrutinize the gates. What's the fourth and final directive? This one sounds like it's less about the contract and more about personal finance reality, the behavioral gut check.
Yeah, this is where you have to be brutally honest with yourself. You have to look in the mirror and ask the difficult question. Could I truly afford to lose access to this capital? Not necessarily lose the capital itself, but lose the ability to get to it for potentially 18 months or even longer.
Not just could I afford the loss, but could I afford the lockup?
Exactly. There are two very different risks. Perlin needed his $50,000 immediately for those medical costs. He struggled for 6 months just to get $38,000 back. If you are a retiree living off your portfolio withdrawals, following a specific decumulation schedule, if you're saving for a house down payment in the next few years, if you have aging parents who might need financial help, if you might face job loss or any other unexpected need for emergency funds, the answer for most solo savers, most regular people, has to be a resounding and absolute no. You cannot afford to have that capital frozen for an indeterminate period. The access risk is simply too high.
It really seems like this entire deep dive, even though we've been exploring these complex, seemingly cutting-edge financial products, it ultimately just loops right back to the most fundamental bedrock principles of sound investing, doesn't it?
It really does. And Zweig drives this home by using a classic quote from Benjamin Graham, the mentor to Warren Buffett, the father of value investing, to summarize the core behavioral risk that's really at play when individuals chase these non-traditional, high-fee, illiquid returns.
What was the Graham quote?
Graham's wisdom here is just timeless, he famously stated. The investor's chief problem, and even his worst enemy, is likely to be himself.
Ourselves as the worst enemy.
Yeah, that desire for higher yield, the fear of being excluded from what the smart money is doing, maybe a bit of arrogance in believing you can navigate these complex institutional structures without having any real institutional muscle. It's that self-inflicted ambition, that behavioral trap, that leads individual investors to accept these incredibly restrictive illiquidity terms. Terms that only massive, truly permanent institutions with infinite time horizons can actually afford to endure. You're essentially signing up to play by the rules of the giants, but without having the giants' ability to survive the game.
Well, this has certainly been a critical and I think very deep examination of this rapid shift towards democratizing private funds. If I had to summarize the core takeaway, it seems pretty stark. These funds, they successfully seduce individual investors with that promise of higher returns.
The allure is strong.
But the structure can potentially strand those smaller savers on very illiquid shores, precisely because the individual lacks the scale, they lack the influence, and maybe most importantly, they lack the necessary time horizon that the big institutional players take for granted.
That's it perfectly. The ultimate lesson here for the individual investor, the practical takeaway, is that scale isn't just about how much money you commit initially. It's really about structural survival. If you are an individual investor managing your own future, liquidity cannot be an afterthought. It must be a primary design feature woven into your entire investment strategy from the start.
It can't be something you just hope the general partner will provide out of goodwill when a crisis hits.
Absolutely not. It can't be treated as optional, something the GP gets to decide on based on their needs during a crunch. You need to design for it yourself.
And as we look ahead, with all the ongoing buzz about technology potentially solving these problems, making secondary markets more efficient, creating more hybrid fund structures, we really need to keep Zweig's final provocative caution in mind, don't we? Technology might fix the plumbing.
Right. It can make the process of transactions easier, faster, maybe cheaper.
But as he says, it cannot fix the fundamental physics of locked capital.
That's the core truth. If the underlying asset itself is inherently illiquid, maybe it's a minority stake in a private company, a loan to a struggling business, a half-leased office building, that asset simply requires patience, scale, and time to manage properly and eventually sell at a fair price. No amount of tech overlay changes that fundamental reality.
So the final provocative thought for you, the listener, building on Zweig, might be this. If you accept that the fundamental physics of capital cannot easily change, that true illiquidity requires real patience and endurance, then how much of a premium, through high fees and that illiquidity drag we quantified, are you truly willing to pay for access to these assets, knowing that the physics of getting your money out quickly when you might need it most cannot and likely will not fundamentally change?
That really is the ultimate liquidity litmus test, isn't it? Every solo investor considering these products needs to apply that test rigorously to their own situation before committing any capital.
Definitely something critical for you to consider as you review your own portfolio and your own needs. We really appreciate you diving deep with us today on this complex topic.